Welcome, everyone. Today, we're diving right into a full explainer of Target's highly publicized Q1 2026 financial turnaround, and of course, how they're stacking up against their undisputed biggest rival, Walmart. We've got a lot of fascinating ground to cover today, comparing their strategic moves and figuring out what all of this actually means for retail investors right now.
Okay, so let's kick things off with just one single number, 5.6%. Now, this percentage represents Target's biggest jump in comparable sales in 4 whole years. It is a massive return to positive momentum after 3 consecutive quarters of declines. But you've got to wonder, how exactly did a retailer that was struggling so deeply suddenly post such a dramatic reversal?
Well, to understand how they pulled this off, here's our roadmap for today. We'll start by looking at breaking the retail slump, then unpack their $6 billion plan, analyze those Q1 results, explore their digital growth, and finally place Target head-to-head with Walmart.
Part 1. Breaking the Retail Slump.
Before this incredibly strong quarter, Target was frankly struggling with a 3-year slide. They were bogged down by this perfect storm of headwinds. Sure, macroeconomic pressures like surging gas prices definitely didn't help, but there were also some pretty serious execution issues happening. Shoppers were walking in and being greeted by disheveled aisles and empty shelves. It was a far cry from that fashionable, affordable niche that originally earned the brand the affectionate nickname Target, right? Add in some consumer pushback over cultural controversies, and they found themselves facing 3 straight quarters of negative comparable sales. Bottom line, they needed a massive reset.
Part 2. The $6 billion plan. To fix this slump, new CEO Michael Fidelka, who is actually a 20-year company veteran, unveiled a massive $6 billion strategic growth plan earlier this year. And the crucial point here is how all this capital is actually being deployed. Target is investing over $1 billion in capital expenditures and another $1 billion in operations just in 2026 alone. This whole strategy is being driven by 4 core priorities. They want to lead with merchandising authority to bring back that signature style and value, accelerate technology like AI, elevate the physical guest experience, and strengthen the team through training and payroll.
And for this year alone, they aren't just making minor tweaks. They're executing the largest store transformation in a decade. We are literally talking about opening over 30 new stores, completing more than 130 full store remodels with totally refreshed floor plans, and investing hundreds of millions to run over 300,000 team members through brand new guest experience training. It's a massive operational overhaul designed to make going to the store an actual destination again.
Part 3. Q1 2026, a promising start.
So the strategic investments? They're already showing up on the balance sheet. Target's net sales hit $25.4 billion, growing 6.7%, which easily topped analyst expectations. And the best part is, it wasn't just driven by price hikes. They actually saw a 4.4% increase in store traffic. What's even more impressive is that they saw broad-based positive momentum across every single one of their 6 core merchandising categories. Everything from apparel all the way to food and beverage.
Let's break down exactly what shoppers were actually throwing in their carts. The new merchandise is clearly resonating with people. They introduced 3,000 new items in food and beverage, and sales from those specific items grew more than 50%. Health and wellness saw double-digit growth after they added 1,500 new items. They also really leaned into affordability, with toys under $10 driving significant growth, and they introduced a brand new premium baby boutique. You add all that to exclusive, buzz-building brand partnerships with labels like Roller Rabbit and Pokémon, and you can instantly see why traffic is surging. People are just choosing Target more often.
Now, despite raising their annual revenue outlook and seeing adjusted earnings per share jump 32% to $1.71, leadership is intentionally avoiding a victory lap. Like CEO Michael Fidelka emphasizes, they're maintaining a cautiously optimistic tone. They know they still have a ton of operational work to do, and consumers are still weighing multiple macroeconomic headwinds. Basically, they don't want to swing too hard too quickly.
Part 4. Digital growth and fulfillment. Getting beyond the physical stores, Target's e-commerce ecosystem is showing some of its absolute most explosive growth in over a year. Overall, digital sales grew 8.9%, which is their highest e-commerce growth rate since 2024. But honestly, the real story here is in the margins. Instead of just looking at a top line, notice how their higher margin, non-merchandise segments are scaling incredibly fast. Same-day delivery tied to their Target Circle 360 membership grew over 27%. Their third-party digital channel, Target Plus, saw gross merchandise volume increase by nearly 60%.
and their ad network, Roundel, helped drive a 25% jump in non-merchandise sales. And all of this digital growth feeds directly into a revamped supply chain strategy. To fix the out-of-stock nightmare that plagued them last year, Target is heavily leveraging AI for demand forecasting. Because they fulfill more than 95% of their sales directly from physical stores, they have to optimize exactly how products flow through the network. So they're opening new regional facilities, like a receiving center down in Houston and a food distribution center in Colorado, just to ensure reliability and freshness.
Part 5. Target versus Walmart. Now that we've analyzed Target's internal turnaround, we have to look at how they compare to the undisputed heavyweight of the sector. With both of these retailers reporting Q1 earnings in the exact same week, and both under relatively new CEOs, it begs the ultimate question. For a retail investor, which stock actually presents the better opportunity right now?
Looking at the raw financial metrics from the Motley Fool's analysis, the contrast is actually pretty stark. Target is clearly priced as the bargain here. It boasts a cheap price-to-earnings ratio of around 17 and a very generous 3.6% dividend yield. Walmart, on the other hand, demands a steep premium valuation with a PE near 42 and a dividend yield of less than 1%. But you really have to look at Walmart's growth numbers. They posted 7.3% revenue growth and a staggering 26% growth in global e-commerce.
So why the massive premium for Walmart? Well, when we compare their business models side by side, Walmart offers something Target simply cannot match: Sam's Club. This provides a powerful, highly resilient recurring revenue engine through memberships that serves as a massive buffer during tough economic times. Target's business, however, leans much more heavily on discretionary product lineups, things people want but don't strictly need to survive. So while Target is a fantastic deep discount valuation play with a great yield, Walmart is viewed by a lot of analysts as the safer, higher quality business to own through unpredictable economic cycles.
Target's comeback is undeniable, and their multi-billion-dollar strategy is actively reversing years of decline. It is off to a fantastic, broad-based start. But it leaves us with one final thought to ponder as we wrap up this explainer. In a cautious consumer environment, is it better to bet on an undervalued, high-yield turnaround story like Target, or is it wiser to just pay the premium for Walmart's unstoppable compounding scale and recurring revenue? It is a fascinating retail battle, and for sure one we'll be watching closely as the year unfolds. Thanks so much for joining me today, and keep questioning the numbers.